Thanks for coming to the session today. And I'll try to be succinct, talk a little bit about the macro, how I think that impacts, our business, the impact of the lower oil prices and the volatility over the last few years, and that impact on our investing. The role of PE generally in oil and gas, and how we kind of fit into that space with the other players. Also what we see as the opportunity today and how we plan to capitalize on it. And then, first I just wanted to kind of quickly introduce myself and Juniper. So I'm Edward Geiser, the managing partner and founder of the firm. I've spent 17 years in energy, with over 10 of those years spent in private equity investing in energy, both at Oxzip, big hedge fund in New York, as well as for Juniper. So it's strange because what's on the screen is not what's on this screen. So Juniper is a middle market PE firm based in Houston. We focus on smaller oil and gas investments solely in the U.S., so the lower 48 onshore. One of the things that we think differentiates us is prior to launching this most recent fund, we spent the time and hired the petroleum and reservoir engineers to go and look at the actual production of every well drilled throughout the United States. We forecast out that well's production over its entire life, and so across every major basin. We took that production profile and created an algorithm that would estimate the cost to drill and complete that well if you were to do it today. And that algorithm is based upon a lot of individual factors of those wells, including vertical depth, lateral length, how it's completed, how much water is used in the drilling operation, how many casing strings. And so once you get an individual well's cost and its production profile, you can assume a commodity price environment and calculate what the returns would be all the way down to that well level. And so this database that we created is now about 235,000 individual wells that have individual returns calculated for each one. Now, effectively, that's just a sophisticated filtration tool, and that's what we kind of use it for. We have a screen that's about this size, and when a new potential investment comes in, it is extremely useful and helpful to be able to just look at that database and figure out whether we think you can make money in that area or not, basically. In terms of the other members of the team, so I'm joined by two partners. The three of us started working together 17 years ago. We have 4 additional people on the investment team and then 3 administrative people. All of us have been working together for years, and I think there's a lot to be gained from having that camaraderie and the team being stable and really knowing what each other's strengths and weaknesses are. We most recently raised a fund that closed late last year, $500 million, and so our focus and where we think we achieve the best returns is generally in that $50 to $60 million space of equity deployment. In oil and gas, you can stage those investments in over time and thereby de-risking some of the assets as you invest in them. So just quickly on the macro from a global perspective, really, while oil and gas production over the last few years has been declining in the U.S., it is kind of amazing looking back over the last 10 years how much the U.S. has grown from the standpoint of its percentage of the overall global production. So in terms of while oil prices were their highest, so prior to 2014, the U.S. is really the only major producing market that materially grew its overall production. Most others were maybe slightly up, some were down, some were flat. What allowed that to be possible was drilling longer laterals, so turning the drill bit to the sideways, and drilling and really accessing more of the producing hydrocarbon reservoir. And it also was enhanced by hydraulic fracking. And what that effectively does is just open up the pore spaces that already contain the hydrocarbon in order to allow that to flow to the reservoir. And what producers have been able to get really good at is really increasing the efficiencies and making it more like a manufacturing process as opposed to each well as individual. And so that's really driven the cost down. And you can see that particularly when you've had the downturn over the last few years. While production has been reduced, you're actually starting to see an uptick in oil production again over the last few months on a severely decreased rig count. which is, interesting to see, and I think has taken some people by surprise if you had asked them just a few years ago where we would be at sub $50 oil today. So in terms of the impact of the lower oil prices and on the ability to actually develop, one thing that's somewhat unique about the oil and gas industry is that your PP&E base goes away every year. You produce it. And so even in order to keep that flat, you have to reinvest. And so generally most oil and gas companies, whether they're public or private, they take that operational cash flow that they generate and they redeploy it in order to grow the overall production. And if they're really good at it, then they're able to redeploy that capital, grow overall production, and live within their means. A lot of companies will borrow, in addition to what they produce internally. And so if you look at the macro impact of that, from 2014, you had about $200 billion that was created in operational cash flow in the U.S. from companies operating there, both public and private. Well, with the downturn in oil prices since that time, so 2015, 2016, and 2017 estimated, you're down by about 50%. And so you've had about $100 billion of capital that would have gone into drilling in each year has been taken out of the market. And so in terms of the overall role of private equity, that $100 billion gap in the U.S., private equity has started to fill some of that role and replace some of that capital that would have been invested by the bigger companies. Now, in terms of why the U.S. has been, generally a technological leader, I actually think it has a lot to do with this slide. I mean, when you think about, I think when the general public thinks about oil and gas in the U.S., they tend to focus on just the largest producers, so the Exxons and the Shells and the Chevrons. But if you take the top 10 oil producers and the top 10 gas producers, they actually produce a little less than a third of all the production in the U.S. And the other categories in these pie charts, so the gray, kind of bigger sections of the pie charts, are comprised literally of thousands. You've got 10,000 operating companies in the U.S. And so you have this massive fragmentation. What private equity is able to do is identify good areas, smaller companies and smaller teams that have the expertise and access those good areas through those smaller teams. And so in terms of kind of the way we think it's best to do it, this slide shows you just a breakdown of just a handful of energy funds, kind of smaller ones like us raising sub $1 billion in terms of fund size. Those that raise kind of in the middle, so $1 billion to $3.5 billion, and then those that are kind of the mega energy funds. Of course, we think that we do it better because we're on the smaller end of the scale. I think the reason that we think we've got better opportunities is because we're not necessarily competing with all the big guys or the big public companies. So there's a lot of deals out there, thousands of companies that are in existence in the U.S. that have operations, that have geologists and engineers. Most of those companies need money on an ongoing basis, and so you've got a big pool of groups to pick from. But most of those groups, because they're based in Midland or Tulsa or someplace like that, and they're trying to raise $50 million, are not necessarily hiring Goldman Sachs or Morgan Stanley in order to go out and raise that money. Whereas if you're KKR and you're trying to deploy $500 million at the minimum, generally the people that you're going to be dealing with are Goldman Sachs and JP Morgan and Morgan Stanley. And that's not to say, I know the guys at KKR, they do a good job. The guys that are on the larger scale here do a nice job. It's just a different, in my opinion, it's a different risk-adjusted return profile because you've got a lot less competition on the front end in what we're doing. And we don't necessarily see a lot of our teams talking about the other private equity providers at the smaller end of the space. I would say the downfall of, or the negative of what we do at the smaller end of the scale is those larger companies, I think they generally view a strategic sale as being more attractive as opposed to an IPO. Realistically, an IPO for us is not that likely in terms of an exit. And so you're generally looking to monetize and exit in the form of a strategic sale, generally all cash, could be a mix of cash and stock if it's a publicly traded company. And then every once in a while, like now you've got this wave of SPACs or special purpose acquisition companies that has been, they've raised cash, and so you theoretically could combine with one of those SPACs and thereby be a public company or have exposure to a public company, but you're not actually doing the IPO in that case. In terms of kind of why, or some of the data that we believe kind of underlies the ability to create better risk-adjusted returns at the smaller end of the scale. This chart does a little bit of that. And so what this illustrates is over the last 10 years, every deal that had any published metric on the dollars that were paid, so transaction value divided by the total proved reserves that were acquired. At the smaller end of the scale is the dark blue line, so transactions under $100 million. The middle range, 100 to 500, is kind of that lighter blue line, and the lightest blue line at the top are the bigger transactions, $500 million or greater. And what you can see is a clear trend. So every single year, the smallest deals, so those done at $100 million or less, they actually trade for less dollars of transaction value per barrel of reserves, and it's in all the same basins, and it's a lot of the same plays in terms of formations that are being invested in. But this is just an illustration with the data of the point that I was kind of talking about, that generally the larger a deal gets, the more attention it's going to get from the bigger, well-financed, sophisticated players, and therefore it trades for a higher value. That's why we generally try to focus on sub-$100 million deals. I'm going to give you a couple of examples later of transactions that we've done over the last 18 months. Both would be at sub $7.50 on a dollar per proved reserve basis. From our standpoint, the real focus is, aligning yourself with a high-quality team who has expertise in the area, finding assets that are going to be robust in a lower for longer price environment, and finally getting in with a structure and at a valuation that you think gives you that asymmetric return profile, protecting the downside, but also giving you upside exposure. And so to go through one of the things that I mentioned just a few minutes ago, so this is an output, it's just a screenshot basically of that well-level database. And so it shows the entire US, all these little dots, which just kind of look like blobs on the map, are individual wells. And so when you get 250,000 wells in there, it just kind of looks all smeared together. But we use this to understand where the economic trends are across all these various basins, but you can also zoom right in. So this map is like Google Maps. You can just zoom in all the way to the individual well level, and underlying each one of these dots is who drilled it, how much oil, how much gas it's going to produce, how much it would cost to drill today, and what the individual break-even price of oil or natural gas is for that well. And so when you're looking at an asset, it's a really powerful tool to understand, okay, is this an asset that's going to perform in a lower for longer environment, or is it an asset that probably does pretty good at $80 oil, but is going to do horribly at 40? And so one thing I'd point out that just jumps out at me, so we ran this model just for this snapshot at $50 flat oil and $2.75 gas. I think gas is higher today. I think oil's a little lower today. But we just had to pick a point that we thought was, a decent flat price going forward. What you notice is that in all these different basins, so from California to Texas to North Dakota to Pennsylvania, you've got wells at those prices that the darkest green is going to be a 3x return at the well level. So whatever it cost you to drill the well, you're going to get 3 times that amount of money back or better. Whereas the pink, if you go down the scale, that well's going to lose money at that price tag. Well, in every basin, so you've got the Permian Basin, which is in West Texas, Southeast New Mexico. It's a really popular place to invest over the last couple of years. You've got a lot of dark green dots, which also have pink dots sitting next to the green dots. And so it really, really matters, particularly at the smaller end, exactly where you're investing the money and aligning yourself with the right operators, which you can use this database to go and sort who the operators are that perform better in a given player basin. And so you could use it both from a diligence standpoint on your teams, looking at their performance versus their peers, as well as really digging into the asset level returns. In terms of the management teams and the assets that we currently own, we just highlighted those basins in yellow. So we're in South Texas, West Texas, Southeast New Mexico, North Texas in the Fort Worth, Colorado and Wyoming in the DJ Basin, the Powder River Basin, which is in Wyoming, and then the redevelopment of an old field in southern Michigan. One powerful thing, too, is that if you want to see the overall cost curve in the U.S., you can take every single well drilled in 2016. You could say, okay, I've already calculated the break-even price of each one of those wells. Let me just stack those wells up from the lowest break-even, at the bottom left, all the way to the highest break-even. And there was about, in 2016, there was about 15,000 wells drilled in the U.S. In 2013, there was about 35,000 wells drilled, so that's just a result. Did you have a question, or? Sure. Yeah.
When you're doing that kind of sort, I would hypothesize that completion really matters nowadays.
Mm-hmm.
And so, you're probably looking for the best rock when you're, backing teams to, get acreage and develop. So how do you abstract out, how the completion was done and so forth to really get to, data that you can use when you're really want to get to kind of like the rock that you want to buy as opposed to the completions that you've done?
And that's a good point. So what we do as an initial screen is look at something like this and kind of look at where those assets are versus where the economic trends are and where you can make money. When we take that next level of diligence, so if every well drilled around, no matter how it was completed, doesn't work, they're stinkers, you're probably just going to pass. You move on. And you do that more often than you engage. If you engage, then you start to try to look to correlations of exactly what you're talking about, whether it was how intense the completion was, how much sand was used per foot, how they actually did the drilling, where exactly in the formation did they land the well, the lateral. And so this database, in terms of getting all that data, we compile it from a bunch of different sources. And so there are data aggregators like IHS or Drilling Info, and so we'll compile that. But you also have a lot of completion information on other sites like the EPA's Frac Focus website. You can also go to the sundry reports in states like Oklahoma or North Dakota and pull the actual completions and the directional surveys. And so really this database, we think it's a competitive advantage for us because we've compiled it from both public as well as proprietary sources. So when we look at an actual deal, we'll input that into the database as well. And so you get as accurate information as you can. And so you're making the initial decision based upon economic trends, but then the go-forward decision based upon a lot of those more specific correlations. Yeah, does that respond to your question? Okay. So in terms of kind of going through a couple of individual investments that we made, just to kind of explain how we approach it and how we use kind of our approach and network and database. So the first one was an investment that we originally made in the first quarter of 2016. The team on this one had been backed by a very well-known upstream private equity firm 3 times in the past, and they had shown success investing that money as well as monetizing those assets for a good return. I had actually gotten to know the team because I had formerly had an investment in North Dakota on a Native American tribe, the Fort Berthold Reservation. The Native American Tribal Business Council wanted their big managers to go up there and present. And so I'd end up sitting next to these guys who were representing another company. And so fostered that relationship with them. They're based in Denver. We actually found an asset through our network and through that proprietary kind of looking for those areas that make good returns. So brought the individual asset, which was the acquisition of about 90,000 acres that span northern Colorado and southern Wyoming. Brought it to them. They did diligence. We negotiated directly with the seller, who was a private company based in Denver. Acquired those 90,000 acres for $6.5 million, which gave us a lot of running room and a really good acquisition cost. Again, a $6.5 million acquisition is probably going to fall way below the radar screen for some of our bigger competitors. So we had a team that we had experience with, who had the experience. We had an asset that we felt like we had already identified proactively that was capable of producing good economic returns. We married those two together. We were able to, express that in an economic way or get in at a low cost. And the value creation is really from a combination of buying it well, overlaying a team that's got the experience. We've now drilled and participated in a total of 9 wells. These wells would have break-even cost on the oil side sub $30 a barrel. There are also these stacked play potentials, which is everybody's kind of favorite topic now, that you could use one pad site and have minimal environmental impact, but address multiple formations. And the plan is to exit to a larger player, be that a public company, or actually we've gotten a lot of interest from some of the private equity-backed groups who have capital commitments from like an NCAP or NGP or Quantum, but don't yet have assets in those areas. In terms of the next one, it's just a little further north in Wyoming. Okay. It's a little further north, a little bit different approach in that this was less about leasing and drilling and more about acquiring assets really well. We identified an area that we felt like had good economic returns but hadn't been redeveloped lately in northern Wyoming. Found an asset that, based upon our proprietary database, was producing a lot of cash flow, was able to go and approach the seller, who was just an individual that lived in Gillette, Wyoming, and so approached him directly, and we executed on that and acquired almost 2 million barrels, 1.8 million barrels of proved developed producing reserves, so ones that are already flowing, for about $13.5 million, so about $7.50 a barrel earlier this year.